Hey, how's it going? Bill Lethman here for Money Evolution. Well, it's been about a week since the One Big Beautiful Bill passed and was signed into law by Donald Trump on July 4th of 2025. And I continue to pour through all of the details and really understanding everything that's going on with this bill and how it's going to affect you, how it's going to affect me, how it's going to affect our clients. And I recorded a video yesterday where I went through all of the highlights of the bill. In fact, it ended up being about a 40-minute video. So if you want to take a deep dive and really understand some of those big bullet point items that are inside the bill with a little bit more in-depth discussion that you might see in some other videos, go ahead and check that out. We'll put some links down below as well. But one of the things I mentioned in the video yesterday was talking about this increase to the SALT cap deductions. SALT is the state and local tax, and in the last tax package that came out, the Tax Cuts and Jobs Act that went into effect in 2018, they really limited those state and local tax deductions, and it was limited to just $10,000, which is pretty low. And what it ended up doing is it ended up getting a lot more people to take the standard deduction instead of itemizing their deductions. In fact, it went from about 30-something% that used to itemize their deduction to now where it is today, which is right around 10% of people choose to itemize. Well, this increase in the SALT cap deduction is certainly going to get a few more people to itemize. And in the video yesterday, I said that this deduction or this additional cap that you're going to be allowed to take under the SALT cap rules it could amount to maybe $7,200 of additional money back in your pocket if you were in, let's say, the 24% tax bracket. And as I started really diving into the details and really understanding it and who would likely reap the benefit of that, I thought I should make another video because getting that much of a deduction may not be as easy as it sounds, just getting that extra cap in there, because there's a few more things. And again, we always have to compare that to what we would have gotten had we just taken that standard deduction. In fact, though, if you are in one of those upper income levels, you could even see maybe close to a $10,000 benefit on your tax refund or lower taxation from this increase in the state and local taxes. So anyway, I'm going to get into all the details here in this video, but real quick before I do, if you would like to learn more about what we do at Money Evolution, you can head over to our website, moneyevolution.com. We've also got some great free resources. We'll put links to a lot of that stuff down in the description below, and I'm going to continue to make more videos about the One Big Beautiful Bill as I start to digest it and kind of breaking it down to different segments and who will benefit, how much will you benefit, different income ranges and things like that, so you can really understand what this means for you and your own personal financial and tax situation. Okay, so let's get into the details here. So one of the first decisions you have to make when you're filing your taxes or talking about your taxes is whether or not you're going to take the standard deduction, which is that flat amount or that set amount based on your tax filing status and set by the IRS every year. Usually has a little bit of an inflation factor that goes up a little bit every year. Or when we get something like a new tax package, sometimes there can be a little bit more radical change to that standard deduction. And as I mentioned in the early part of the video, one of the things that happened or occurred as a result of the Tax Cuts and Jobs Act that went into effect in 2018 is they effectively about double the standard deduction for all tax filing statuses. As I mentioned in the last video, though, they also eliminated personal exemption. So that was sort of the trade-off. And then they had a child tax credit that came back into that. You want more details about that, you can check out that other video. But what they did here is with the One Big Beautiful Bill, they also made some changes to the standard deduction. So as it stood before the One Big Beautiful Bill Act went into effect, if you were married filing a joint tax return, the standard deduction for a married filing joint was $30,000, and if you were single, it was $15,000, so exactly half of that. And then the One Big Beautiful Bill Act did make a slight upward revision to that, and it went up from $30,000 to $31,500 if you're married filing joint, or $15,750 if you're single. And as I mentioned in the video I recorded yesterday, the senior bonus deduction, so it would be $2,000 if you're single, or if you're married filing a joint tax return, you get $1,600 for every person that's over the age of 65 when you file your taxes. and so that could be worth as much as $3,200 off of your taxes. And also that new senior bonus deduction that was kind of in lieu of the no tax on Social Security, didn't quite get there, but the senior bonus deduction of $6,000 per qualifying person over the age of 65 as well. So that is going to be there whether you choose to itemize your deductions or not. So that's very important to recognize that. But basically, as we're talking about taking an itemized deduction, which is what we're really going to get into here, and what the impact of that state and local tax increase from $10,000 a year to $40,000, we need to compare that to what it would have been had we just simply taken the standard deduction here. So those are the numbers that we kind of have to beat, and what we're talking about here for 2025 and beyond is really that $31,500. So in other words, if our deductions are greater than that, it's going to make sense to itemize our deduction, but if it's less than that, we're going to be just better off to take that standard deduction. So as I mentioned in the early part of the video, the opening part of the video here, this state and local tax deduction could be worth a pretty good amount of money net to you as either a refund or a reduction to your overall taxes for the year. And I said this in yesterday's video as well. We said that it could be worth about $7,200. And I came up with that basically by calculating that off of, let's say you're in a 24% tax bracket, and I took the extra $30,000 that you're going to get for the state and local tax deduction versus the $10,000 that you would have gotten had this one big beautiful bill not passed, and 30,000 times 0.24 would be $7,200. That's how I came up with that. And then if you're at sort of the upper end of the range of income here for where this state and local tax deduction is going to apply under married filing joint, you could be reducing some of your income at a 32% tax rate if you're hitting those upper levels there. And if you're filing a single tax return, you could even hit a 35% tax rate. So in some cases, many cases here, it might actually favor a single tax filer a little bit over a married filing a joint tax return tax filer, and that's going to be for a couple of different reasons. Remember, in order to itemize your deductions, your itemized deduction total has to beat whatever your standard deduction is. And so for a single, with this new increase to the standard deduction, that number is $15,750, and if you're married filing a joint tax return, it's $31,500. So you've got a bigger hurdle to get over. Now, one of the things that you need to know is that the state and local tax deduction, that $40,000, is the exact same whether you're a single tax filer or if you're married filing a joint tax return here. So that $40,000 is going to apply in either case. So you have a much bigger amount of deductions that you can take in that state and local tax arena. The other reason and why this sort of gets topped out and why are we stopping at 32% or 35% and not going all the way up to the highest tax rate, which is 37%, and that is because there's actually a phase out. So it does favor the higher income levels, but only to a point. Once you get to $500,000 of income to $600,000, you're going to start to get phased out. And if you have income over $600,000, you're going to be completely phased out of even being able to take any of these state and local tax deductions here. So that's really important to know. So while it does favor somebody that might be making $400,000 or $500,000 more than it's going to favor somebody that's probably making $100,000, it's going to completely eliminate it for somebody that's making $1 million or a couple $1 million a year. So that's a little bit of a trade-off. I would say that's maybe upper middle class. And the reason why we don't go lower than 24%, it would be technically possible for somebody to hit that $40,000 in state and local taxes if they were making, let's say, $150,000 or $200,000, but it would probably be more unlikely that that's going to happen. I'm going to get into that a little bit more detail because they're not going to have the income, and that's going to be a big part of what those state and local taxes are going to be based off. It's going to be based on the amount of state taxes that you're paying, and the other part of it is going to be your property taxes. So obviously, the more properties you have or the higher the value of your properties, the more property taxes you're likely going to be paying. That's going to push that up there as well. Okay, so now to really see the maximum benefit of the state and local tax deduction, there's really going to have to be two things that are going to happen here in order for you to maximize this. Number one is you need to obviously have at least $40,000 of state and local taxes that you can deduct. And that may seem relatively simple or easy, but when we start getting into some of the numbers here, and this is what I started thinking about yesterday after I filmed that video, is that this isn't going to really apply to as many people as it may first appear to. And to illustrate this, let's look at a hypothetical example here. Let's say that you do live in a state that does have a state income tax like we have here in Michigan. Our Michigan state income tax is 4.25%. But just to keep things relatively simple here, let's just round it down to 4%. Other states like California or New York, you might see 5% at this income level. Maybe it would be a little bit over, somewhere between 4 and 5%. New York might be in that range as well. And then you certainly can hit some really high income tax rates in those states like New York or California. But again, remember, the state and local tax deduction is going to be phased out beginning at $500,000 of income. And that's why some of those higher income brackets aren't even going to apply to this anyway. But assuming 4%, that would be $8,000 of total state taxes that we're going to pay. And so if you're making $200,000, depending on when you bought your house and how much it's worth right now, if you think about it, property taxes in most states tend to run about 1% of the property value. So even if you had $1 million home, for example, that would be $10,000 of property taxes that you're paying. And so the total of that obviously is $18,000. So yes, you are getting an extra $8,000 of a tax deduction with this increase here, but you're not fully maximizing that full $40,000 level. If you jump up to a higher income bracket, for example, you're going to have to probably get somewhere between $400,000 and $500,000 to really get to that $40,000 of state and local tax. So if we had $400,000, so that would be $16,000 of state income taxes that you're paying, and then whatever your properties are, you're probably going to have a pretty expensive property, or you're going to have multiple properties to make up that difference there of an additional $24,000. So maybe if we're talking 1%, that's another $2.4 million of home value to get to that $24,000, to get to that $40,000. So if you had $500,000 and you did live in a higher tax state, now we're starting to get into those areas or those people that are really going to benefit from this. If you are in one of those really high tax states and you hit 5% on $500,000, well, that's $25,000 in your state income taxes, and then basically just make up another $15,000 of property taxes, which on $1.5 million home or $2 million home would have probably no trouble getting to that level there. So that, again, may not be as simple to say, okay, $40,000, I feel like I'm paying a ton of state taxes, but to get to that $40,000 level really takes probably a higher income and some property taxes that are going to be above average on that. The second thing is you're going to need to have some other deductions. So let's say you even get to that $40,000 of state and local taxes. Remember, compared to the standard deduction, which was just raised here with this One Big Beautiful Bill Act to $31,500, you basically are only $8,500 above that standard deduction if we're talking about a married filing a joint tax return. And that's why I said if you're single, that difference between the $40,000 that you're getting for the state and local tax versus that $15,750 standard deduction is going to be a much bigger amount there. It's going to put you into a much higher ability to capture more of the state and local tax. So if you just had the $40,000 in state and local tax deductions, but you didn't have any other deductions, then the benefit would be limited to just the amount of that $40,000 versus what your standard deduction would have been here. So for a married filing joint, the standard deduction is $31,500, and so the difference of that versus the $40,000 would be $8,500. So our net benefit here in this case is we got $8,500 lower on our taxable income by this increase. We didn't have any other deductions, so we're $8,500 over the standard deduction, and in the 24% tax bracket, that works out to be just about $2,040. If we're single, and again, I mentioned earlier that I think that if you're in one of those higher income brackets and you have some of these deductions, there's a lot more room for improvement with a single, because the difference is that $40,000 of state and local tax versus a standard deduction of $15,750. So that's going to be a difference of $24,250 that's going to be above that standard deduction, and that's going to equate in the 24% tax bracket to $5,820. So a big difference there. So that's why I say number 2 in this equation for really getting that maximum benefit is you're going to have to have enough other deductions over and above the state and local tax deductions to basically be at least as high as what your standard deduction would be. And again, that's going to be $15,750 for single and $31,500 for joint. So let's talk a little bit about what those deductions typically are. So probably the biggest deduction that a lot of people might have or could have here is going to be your mortgage interest deduction here. And under the Tax Cuts and Jobs Act that went into effect in 2018, they lowered the amount of indebtedness, total home indebtedness that is going to qualify for this mortgage interest deduction. It was $1 million of indebtedness, and now it's $750,000 of indebtedness. So if we kind of look at that, and I did some numbers on this, and say you have the maximum loan there, you have a $750,000 loan, and let's say that you got your loan a few years ago, and it was 3.5%, which would be a pretty good rate. I know some people have a little bit lower rate there, so at 3.5%, that would be $26,250 or $26,250 would be the total interest that you're paying. If you took out a loan relatively recently, you could have a mortgage that could be twice that amount at 7%, let's say. And if it was at that $750,000 level, that would be $52,500 would be the amount of interest. And so there, with the 3.5% on a $750,000 mortgage, which would be the maximum, you're still not getting, if you're married filing joint, up to that $31,500 standard deduction. With 7% or maybe somewhere in between, closer to the 7% range, you're going to have a much easier time to get there. So the mortgage interest is going to be a part of that. One thing that I mentioned in yesterday's video as it relates to mortgage interest, and hopefully if you're one of these higher income brackets, you're not doing this, but if you do a mortgage where you're not putting down that full 20% minimum, you're going to probably have something like a PMI or a private mortgage insurance. They did bring back the deductibility of that mortgage insurance as it relates to going into your itemized deductions here. So especially like I've got adult kids that are in the process of shopping for their first house, we're trying to get them to that 20%, but if they fall a little bit short potentially and they have that, at least it's deductible now under this new rule here. They did bring in auto loan interest. So some people are thinking, hey, I can deduct my auto loan interest. Well, there's going to be some limitations to that. First of all, it's going to be limited to $10,000 of interest, which is a pretty high amount, but that also equates to a pretty expensive car loan as well, a very high balance. It's probably going to be, I don't even know, $50,000, $75,000 car loan. Depending on what your rate is or something like that. So that's something that you probably wouldn't want to have. And there's also a phase out of that as well. And it's going to be $100,000 of income if you're single, and it's going to be, checking my numbers here, $200,000 if you're married filing joint. So again, if what we're talking about here is getting above that standard deduction and hitting those state and local taxes, you're probably not going to hit it at $200,000. So this auto loan interest is probably not going to apply to you. And the last one, there's a couple others here, but the last one is charitable contributions or charity. And so if you do give a lot to your church or to different charities and organizations and things like that qualify for these charitable deductions, then this could be something that could push you up over those limits that we're talking about here, trying to beat that standard deduction in this case here. They did make one change here to the charitable contributions or the charitable deductions for the One Big Beautiful Bill Act, and now it's limited to there's a floor of 0.5% that you're going to have to be above. So in other words, the first 0.5% of your adjusted gross income is not going to be deductible. So if you made $500,000, then 0.5% of that is $2,500. And so what that means is that the first $2,500 of charitable donations are not eligible to be deducted off of your income tax return. So if you had $12,500, your actual deduction for this would be $10,000. Now, one more thing that did change as a result of the One Big Beautiful Bill Act is for people that take the standard deduction, they did now allow for an above-the-line charitable deduction. So if you're single and you're taking the standard deduction, you can have up to $1,000 of charitable donations that's going to be an above-the-line deduction. You can take that without having to itemize. And if you're married filing a joint tax return, that number is going to be $2,000. So something to keep in mind when we're comparing what it would have been if you just took the standard deduction versus what does it look like if you were to itemize the deduction. One other thing that some people may be thinking about here is employee-related expenses. That was a thing that existed prior to the Tax Cuts and Jobs Act, but was eliminated in that 2018 tax package with that Tax Cuts and Jobs Act. They eliminated those employee-related expenses there, except in certain circumstances. I think for educators, teachers, and things like that, they do get some ability to still make those deductions there. Okay, so that's it for this video. I hope you got a lot out of this. I hope it helped you to understand how these state and local tax deductions work with the One Big Beautiful Bill Act, and really how it fits into your individual retirement planning and financial planning situation. So you can hopefully make some better and more well-informed decisions about what you're doing with your money. By the way, I mentioned at the beginning of the video, if you would like to learn more about what we do at Money Evolution, you can head over to our website, moneyevolution.com. We have two financial planning programs that can really help you to put a lot of this stuff together. The first one is a little bit more of a DIY with a lot of educational-based material to help you put together a plan. That's going to really be for somebody that really wants to take a more active role in some of that financial planning. We still use the same great software, the eMoney financial planning software that we use for our high-end Money Evolution plan clients, but it's a way to kind of get in there, map out your cash flows, understand maybe what's happening to your tax situation over the next several years. We expect here with any time we see new tax legislation, anytime within the next month or so, we should get some updates to our financial planning software that'll have all of the new information built into the planning for the One Big Beautiful Bill Act. So we'll probably put some kind of an announcement out when that happens here, so it can allow us to get that insight into the future and what your future tax rates are going to look like there. Money Evolution Plan is where we work with you more one-on-one to really dive into some more advanced scenarios. If you're thinking about doing things like Roth conversions, you're buying and selling properties, you have executive compensation sorts of things like stock options or restricted stock or deferred comp plans, it really does a great job of really sort of mapping that out here. And now that we have some clarity to our current tax situation, we were kind of on pins and needles here a little bit with the expiration of the Tax Cuts and Jobs Act that were supposed to happen at the end of this year, and reversion back to those old tax tables, which would have really just meant higher taxes for everybody. So now we have some clarity. The tax bill and the tax rates that were made as a part of this package were made permanent, and I used that in the last video as well. That term permanent is, there's nothing that's ever permanent when it comes to taxes, but that just means there's no sunset provision or there's no expiration or a time when some of these things are going to revert back to what it was before. So anyway, we'll have some clarity on that now with this new One Big Beautiful Bill. So anyway, if you want to check out some of the information there, we'll put some links down in the description below. We've got some great free resources as well, including our retirement launch kit, where you can get some free worksheets and a retirement planning checklist if you're in that mode to be working on your retirement plan. So anyway, that's it for this video. I hope you enjoyed it. Don't forget to hit the like or subscribe button. Share the video with somebody if you think they can benefit from it, and I'll look forward to seeing you back in one of my next videos. Thanks.